Brazilian President Dilma Rousseff announced industrial reforms April 3rd that will improve the outlook for businesses in Brazil. These reforms include substantial new financing options, tax breaks, trade protections, export promotion, along with research and development incentives. The reforms are designed to reduce the cost of operating in Brazil and make it easier for Brazilian investors to export goods. The reforms address the stagnation of industrial growth that began in early 2010 and are a significant step towards reducing the structural challenges that make producing Brazilian goods uncompetitive. The businesses targeted by these reforms range widely, but include textiles, shipbuilding, airplane manufacturing, IT equipment, and footwear. In the wake of the 2008 financial crisis, growth in Brazil rose to 7.5% in 2010 as commodity demand spiked and investment flowed into the country. However, increasing competition for domestic market share with Chinese producers and reduced international demand for Brazilian value-added goods raised serious concerns about the stability of the Brazilian industrial sector. As a result, Brazil has put in place a dual strategy of raising barriers to imports and incentivizing direct investment by foreign companies seeking access to Brazil's domestic consumer market. This strategy closely mirrors the Latin American policies of import substitution industrialization that were, at least in name, broadly abandoned after the debt crises of the 1980s and 1990s. With the 1994 implementation of the Real Plan, Brazil got a new lease on life as government policy put an end to annual inflation that ranged as high as 2,500%. Global currency turmoil in the late 1990s destabilized Brazil as well, but the reforms put in place that decade set the stage for a boom in Brazilian growth under Brazilian President Lula da Silva. In the course of the past decade, Brazil's prudent financial measures and high growth has made the country the darling of international markets, attracting attention and investment. With continued economic malaise expected in Europe, an ongoing Mercosur trade war, and stagnation in Brazil's industrial production, growth has already fallen significantly and can be expected to remain low over the next few years. However, this does not mean that Brazil is not continuing a long-run trend of gradual emergence as a global economic power. The critical question for Brazil is not growth per se, but instead what kind of growth. Much like its Latin American neighbors, Brazil was for centuries beholden to the boom and bust commodity cycles of coffee, sugar, gold, and rubber. It wasn't until the 20th century that Brazil began to make real progress on producing higher value-added goods. In some cases, Brazil has experienced wild success. This is particularly true in the indigenous generation of sophisticated petroleum technology by Petrobras, the emergence of Embraer as a major airplane manufacturer, and the development of Brazil's substantial ethanol industry. Significant challenges face every Brazilian company. These include finding skilled labor, emerging from behind trade barriers to be competitive with international markets, and overcoming poor infrastructure and challenging geography. High interest rates have stifled capital investment and research, and high taxes have increased production costs and reduced competitiveness. In part as a result of the resources necessary to emerge from these constraints, Brazil's industrialization has been largely concentrated in a few areas, leaving private small and medium-sized companies at a disadvantage. The changes made this week are specifically targeted at addressing some of the easily adjusted changes for a range of industries. While these changes will not solve Brazil's industrial development problems, they go a long way to reducing the cost of doing business in Brazil.